Welcome to another session of corporate level strategies, which focuses on the diversification into more than one business as a strategy for growth. This is actually the continuation of our discussion of corporate level strategies that we began in the previous session. The corporation is viewed as a portfolio of investment, and diversification is considered as a way of further leveraging the firm's distinctive competencies. A corporation can increase firm's profitability using diversification strategies in a number of ways. For example, through transferring or leveraging competencies, sharing resources and capabilities, product bundling, or leveraging general organizational competencies. In this session, we will discuss related and unrelated diversification strategies and the advantage and disadvantage of each of these strategies. We will highlight the issues of bureaucratic costs, which often limits the extent of diversification, followed by a discussion of how best to choose related or unrelated strategies. We will explore the three entry strategies for diversification, which include internal new ventures, acquisition, and joint ventures, and we will also look for the benefits and challenges of each of these entry strategies, along with suggestions about how to increase the chances of a successful implementation of those strategies. The session will end with a discussion on restructuring, which a company pursues as a strategy when too much diversification occurs and that does not create any value for the company. Rather, too much diversification often dissipates the company's value. We will identify and assess various kinds of diversification strategies that include downsizing, downscoping, and leverage buyout. So at the end of the session, you will be able to differentiate between multi-business models based on related and unrelated diversification. You will be able to explain the 5 primary ways in which diversification can increase companies' profitability. You'll be able to discuss the conditions that lead managers to pursue related diversification versus unrelated diversification and explain why some companies use both the strategies. You'll be able to describe the 3 methods that companies use to enter new industries, which include internal new venturing, acquisition, and joint ventures. And you'll also be able to identify the various ways the company can restructure, especially when companies goes for too much diversification that actually doesn't create any value for the company. So let's begin our discussion with a conceptualization of diversification. Diversification is the process of entering new industries which are distinct from a company's core or original industries to make new kinds of products that can be sold profitably to customers in these new industries. A multi-business model based on diversification aims to find ways to use a company's existing strategies and distinctive competencies to make products that are highly valued by customers in the new industries it enters. So, a diversification strategy should enable a company or its individual businesses or business units to perform one or more of the value chain functions at a lower cost or in a way that allows for differentiation, and gives the companies better pricing options, that is premium pricing options, or in a way that helps the company to manage industry rivalry better. Companies does all these things in order to increase profitability through diversification. Companies can increase their profitability in four primary ways through diversification. Number one, when they can transfer competencies between business units in different industries. This involves taking a distinctive competencies developed by a business unit in one industry and implanting it in a business unit operating in another industry. In general, competency transfer increases profitability when they either lower the cost structure of one or more of the business units, or it enables one or more of its business units to better differentiate their products. Second is leveraging competencies to create business units in new industries. That is, the multi-business model is based on the premise that the set of distinctive competencies that are the source of a company's competitive advantage in one industry might be applied to create a differentiation or cost-based competitive advantage for a new business unit or division in a different industry. Third one, if the company's business units are able to share the resources and capabilities between them, although they operate between them that operate in different industries. This is how they can realize synergies or economies of scope. Economies of scope arise when one or more of a diversified company's business units are able to realize cost savings or differentiation synergies because they can more effectively pool, share, and utilize expensive resources or capabilities such as skilled people, equipment, manufacturing facilities, distribution channels, and R&D laboratories, and so on and so forth. Managers must be aware that the cost of coordination necessary to achieve these synergies or economies of scope within a company may sometimes be higher than the value that can be created by such a strategy. So, one of the sources of economies of scope that firms seek through diversification is through product bundling. Okay, so this is how our companies, different business units can satisfy more of the demands of the customers, or they can offer better value by satisfying the complete set of needs of the customers. So this allows a company to expand the range of products it produces in order to be able to satisfy customer needs for a complete package of related products. Final customers want to obtain the convenience and reduced price of a bundle related products. It is important to note here that product bundling often does not require joint ownership. So company doesn't probably need to set up another business or diversify into another industry. For product bundling to serve as a justification for diversification, there must be a strong need for coordination between the producers of the different products that cannot be overcome through market contracts. So you or companies doesn't require to set up a new business in order to offer bundling services to the customers. Companies can actually go for a market contract and still satisfy the customer's need. For most of the smartphone companies these days have developed market contract with the app developers to offer these bundling services. You see, like they do not really, the smartphone companies uh, does not really need to set up different app companies to develop the apps, or software companies to develop the apps, so that they can satisfy their customers the whole set of needs. Okay, and the fourth one is company can create more value through diversification by utilizing its general organizational competencies of all of a company's business units. General organizational competencies transcend individual functions or business units and are found at the top or corporate level of the multi-business company. Typically, general organizational competencies are the result of the skills of a company's top managers and functional experts. There are three kinds of general organizational competencies um, that help a company increase its performance and profitability, and these competencies are called entrepreneurial capabilities, organizational design capabilities, and strategic capabilities. So what is entrepreneurial capabilities? A company that generates significant excess cash flow can take advantage of entrepreneurial capabilities only if its managers are able to identify new opportunities and act on them to create a stream of new and improved products in its current industry and its new industries. In order to promote entrepreneurship, a company must encourage managers to take risks, give managers the time and resources to pursue novel ideas, not punish managers when a new idea fails, and make sure that the company's free cash flow is not wasted in pursuing too many risky new ventures ideas that have a low probability of generating a profitable return on investment. Capabilities in organizational design. Organizational design skills are a result of managers' ability to create a structure, culture, and control system that motivate and coordinate employees to perform at a high level. Organizational design influences a company's entrepreneurial capabilities as well as its functional competencies that give it a competitive advantage. With regard to corporate level strategies, managers must be able to continuously manage and change its structure and culture to motivate and coordinate its employees to work at a high level and develop the resources and capabilities upon which its competitive advantage depends. The need to align a company's structure with its strategy is a complex, never-ending task, and top managers with superior organizational design skills can do this job effectively. Superior strategic management capabilities. In order for diversification to increase profitability, a company's top managers must possess the intangible and hard to define governance skills that are required to manage different business units in a way that enables those units to perform better than they would if they were independent companies. Those governance skills are a rare and valuable capability. An especially important governance skills in a diversified company is the ability to diagnose the underlying sources of the problems of a poorly performing business unit and then to understand how to proceed to solve those problems. This might involve recommending new strategies for that unit or knowing when to replace top managers of the poorly performing firm with the new management team that is better be able to fix the problems. Top managers of a diversified company should also use superior strategic management skills to identify inefficient and poorly managed companies in other industries and then to acquire and restructure them to improve their performance and thus the profitability of the total corporation. This is called turnaround strategies. There are several ways to improve the performance of the acquired company. First, the top managers of the acquired company are replaced with a more aggressive top management team. Second, the new top management team sells off expensive assets. It also terminates managers to employees to reduce the cost structure. When we talk about the selling of expensive assets, make sure that we do not sell the critical capital asset. Number 3, the new management team works to devise new strategies to improve the performance of the operations of the acquired business and improve its efficiency, quality, innovativeness, and customer responsiveness. Fourth, to motivate the new top management team and the other employees of the acquired company to work towards such goals, a company-wide pay-for-performance bonus system linked to profitability is introduced to reward employees at all levels for their hard work. And finally, the acquiring company often establishes stretch goals for employees at all levels. These are challenging goals and hard to obtain goals, but this forces employees at all levels to work to increase the company's efficiency and effectiveness. The members of the new top management team should also be communicated that if they fail to increase their division's performance and meet these stretch goals within some agreed upon amount of time, they should be replaced. So, diversification strategies are of two types. One is related diversification, another is unrelated diversification. Let's discuss this related diversification first. Related diversification is a corporate level strategy based on the goal of establishing a business unit or division in a new industry that is related to the company's existing business. There are some forms of commonality or linkages between the value chain function such as manufacturing, research and development and marketing of these businesses in two industries. And therefore, this linkage or commonality can be successfully tweaked or modified to increase the competitive advantage of one or more business units. The goal of this strategy is to obtain the benefits from transferring competencies, leveraging competencies, sharing resources, and bundling products. One more advantage of related diversification is that it can also allow a company to use any general organizational competencies it possesses to increase the overall performance of all its different industry divisions. Unrelated diversification is a corporate level strategy whereby firms own unrelated business and attempt to increase their value through either an internal capital market or the use of general organizational competencies or both. Companies pursuing these strategies are often called conglomerates, that is, business organizations that operate in many diverse industries. An internal capital market refers to a situation whereby a corporate headquarters assesses the performance of business units and allocates money across them. Cash generated by units that are profitable but have poor investment opportunities within their business is used to cross-subsidize businesses that need cash but have a strong promise for long-term profitability. Please note that unrelated diversification has no intention of transferring or leveraging functional level competencies between business units or sharing resources other than cash and general organizational competencies. If the strategic managers of conglomerates have the special skills needed to manage many companies in diverse industries, this strategy can result in superior performance and profitability, and often many managers do not have these skills, and that is why we will see later that too much diversification can often lead to poor performance or reduction of value of the company than increasing the value. While we have argued so far that through diversification into related and unrelated industry, a company can increase its profitability. But for three principal reasons, a business model based on diversification may lead to a loss of competitive advantage. So we must be careful about that. So what are those reasons? Number one, the changes in the industry or inside the company that occur over time. Number two, diversification pursued for the wrong reasons. And number three, excessive diversification that results in increasing bureaucratic cost. Let's discuss this point a little bit detailed. Changes in the industry or company. In order to pursue diversification, top managers must have the ability to recognize profitable opportunities, to enter new industries, and to implement the strategies necessary to make diversification profitable. Over time, a company's top management team often changes, and when the managers who possess the hard to define skills leave, they often take their vision with them. A company's new leaders may lack the competencies or the commitment necessary to pursue diversification successfully over time, and therefore the cost structure of the diversified company increases and eliminates any gains the strategy may have produced so far. In addition, the micro and macro environment often changes rapidly and unpredictably over time. When new technology blurs industry boundaries, for example, it can destroy the source of a company's competitive advantage. Similarly, when a major technological change occurs in a company's core business, the benefits it has previously achieved from transferring or leveraging distinctive competencies also disappear. Thus, a major problem with diversification is that the future success of a business is hard to predict when the strategy is used. Second, diversification for the wrong reasons. When managers decide to pursue diversification, they must have a clear vision of how their entry into new industries will allow them to create new products that provide more value for their customer and increase the company's profitability. One widely used justification, sometimes false justification, for diversification was that the strategy would allow a company to obtain the benefits of risk pooling. Excuse me. The idea behind risk pooling is that a company can reduce the risk of its revenues and profits rising and falling sharply if it acquires and operates companies in several industries that have different business cycles. However, research suggests that corporate diversification is not an effective way to pool risks because the business cycles of different industries are inherently difficult to predict. So it is likely that a diversified company will find that an economic downturn affects all its industries simultaneously. If this happens, the whole company's profitability plunges. When a company's core business is in trouble, another mistaken justification for diversification is that entry into new industries will rescue the core business and lead to long-term growth into profitability. In desperation, companies diversify for reasons of growth alone rather than to gain any well thought out strategic advantage. So the idea of growth is actually leading managers to diversify. No strategic considerations are given any stress or focus in here. In fact, many studies suggest that too much diversification may reduce rather than improve companies' profitability. Managers also tend to pursue diversification strategies for personal interests such as empire building and or reducing their employment risk. Finally, the bureaucratic cost of diversification. A major reason why diversification often fails to boost profitability is that of bureaucratic costs of diversification. This may exceed the benefits created by these strategies. So what is bureaucratic cost? These are the costs associated with solving the transaction difficulties between business units and also between the company and its headquarters, as the company attempts to obtain the benefits from transferring, sharing, and leveraging competencies. For example, if company A uses company B's competencies, maybe as a consultant, marketing consultant, then how much the company A is going to pay to the company B. This is actually different business units under the same conglomerates, and there is a headquarter office. They basically do this allocation of the cost and also the resources, and that can be sometimes difficult, and it requires a big coordination team that is expensive to manage. And this is why the value that the company gains through diversification can be sometimes lower than the value of this coordination and transaction cost. They also include costs associated with using general organizational competencies to solve managerial and functional inefficiency. The level of bureaucratic cost is in a diversified organization is a function of then two factors. First, the number of business units in a company's portfolio, If we have many more companies, coordination and transaction difficulties would be more complex, so the bureaucratic cost would be high. And second, the degree to which coordination is required between these different business units to realize the advantage of diversification. If we need more coordination because all these businesses are different, and then this bureaucratic cost would be really high. Sometimes in some conglomerate, the headquarter often has hundreds of management people responsible for the coordination of all the business units, and that increases companies' cost. This figure shows the coordination among related business units. These are related, so the cost would be a little bit less in here. You see, we have two units. One is making household products, another is making packaged food products, and the marketing and sales functions are being shared by these two companies. Now, if the marketing and sales functions have $5 million cost, then the head office will have some difficulties in here, not probably much difficulties, about what portion of these marketing and sales cost would be allocated to household products and what portion would be allocated to packaged foods and packaged and food products. So coordination is simpler in here, but when think about a company head office that oversees the these coordination function of say 20 companies operating in both related and unrelated, the cost would be enormous. The time that this head office would spend to coordinate would be enormous. And so in sum, although diversification can be a highly profitable strategy to pursue, it is also the most complex and difficult strategy to manage because it is based on a complex multi-business model. Even when a company has pursued this strategy successfully in the past, changing conditions both in the industry environment and inside a company may quickly reduce the profit creating advantage of pursuing this strategy. Now, choosing a strategy, should we choose a related or unrelated? Because related diversification involves more sharing of competencies, one might think it can boost profitability in more ways than unrelated diversification, and therefore related strategy is the better diversification strategy. Although it is true that related diversified companies can create value and profit in more ways than unrelated companies, they also have to bear the higher bureaucratic cost to do so. For example, if we use resources, we share the resources between two companies, that we just put the example in the marketing, how much are we allocating this overhead, how we are distributing the overhead among all the companies. Now the choice then of strategy depends upon a comparison of the benefits of each strategy against the bureaucratic cost of pursuing it. It pays a company to pursue related diversification when, number one, the company's competencies can be applied across a greater number of industries, and number two, the company has superior strategic capabilities that allow it to keep bureaucratic cost under close control, perhaps by encouraging entrepreneurship or by developing a value creating organizational culture. Using the same logic, it pays a company to pursue unrelated diversification when, number one, Each business unit's functional competencies have few useful application across industries. But the company's top managers are skilled at raising the profitability of poorly run business. And secondly, when the company managers use their superior strategic management competencies to improve the competitive advantage of their business units and keep bureaucratic costs under control. Although some companies may choose to pursue a strategy of related or unrelated diversification, there is nothing that stops them from pursuing both strategies at the same time. This figure illustrates how Sony developed a web of corporate strategies to compete in many industries. Some are related, some are unrelated. You can see the Sony's core business is consumer electronics. So they have vertically they have done vertical integration. They introduced movies and music business. They also went to the backward. That means they were doing these production of electronic components. The core business is consumer electronics. In terms of the diversification, that means they also diversified in related industry like computers, small smartphones, and also unrelated like internal venturing of PlayStations. That is how they have diversified into many areas. But eventually this program proved to be a mistake for Sony, and actually it reduced the differentiation advantage that Sony was expecting to gain, and increased its cost structure between 2000 and 2010. Now same kind of diversion you can see in Netflix. They were actually renting the movies previously, but then now they are also have gone for backward vertical integration. They are now also making movies. Okay, so we can see that companies can diversify in both related as well as unrelated ways. So once a company decides to diversify, what kinds of strategies they should be pursuing to enter into the new industry? There are three strategies that companies can use to enter into a new industry. It could be related or unrelated, but they can and different strategies will be required in different types of diversification strategies. But basically they include three types. One is internal new venture, second is acquisition, and third is joint venture. Let's talk about this a little bit detail. Internal new venturing is the process of transferring resources to and creating a new business or division in a new industry. So we are actually transferring resources on and creating a new business. Internal new venturing is typically used to implement corporate level strategies when a company possesses one or more distinctive competencies in its core business model that can be leveraged or recombined to enter a new industry. Internal venturing is used mostly by companies that have a business model based upon using their technology and design skill to innovate new kinds of products that enter related markets or industries. So you have something, a company has got some technological competencies or design skills that they can utilize to innovate new kinds of products and enter a new industries. Like if you can see these internet-based companies, most of the internet-based companies now allow people to make calls internationally. That was not their competencies previously, but now they have also entered that industry. Uh, so thus technology-based companies that pursue related diversification are mostly use internal new venturing. So you have to be technologically very competent, and they move to other industry. And we can see the high-tech companies these days, they are moving into different industry using their core technology where they have the skills and competencies. A company may also use internal venturing to enter a newly or emerging or embryonic industry. So if the industry is new and there is no one who has got this core competency to start the business, uh, or who are already competing in that industry, so you can start this or you can transfer or use your core competencies to create a product and enter that industry. If there was some competitors already, there was an options, you could buy them, you could acquire them, but now there is no one, no other company that you can acquire. So it is the company's only choice when the industry is emerging or embryonic. uh, Emerging or embryonic industry, that is one where no company has yet developed the competencies or business model to give it a dominant position in the industry. So this is how we can see that many high-tech companies actually entered the new industry, emerging industry, and they become highly dominant in there because there was no other competitors there. Now, what are the pitfalls of these internal new venturing company? If you start a business on your own from the scratch, what could be the pitfalls? Three reasons to explain the relatively high failure rate of internal new venture. Number one, market entry is too small. Number two, poor commercialization of the new venture product. And number three, poor corporate management of the new venture division. Let's talk a bit about these three reasons. Research suggests that large-scale entry into a new industry is often a critical precondition for the success of a new venture. In the short run, this means that a substantial capital investment must be made to support large-scale entry. Thus, there is a risk of major losses if the new venture fails because the company has invested a substantial amount of capital. Large-scale entrants rapidly realize scale economies, and they can also build brand loyalty and gain access to distribution channels, all of which increase the probability of a new venture success. If the company starts with a large scale. In contrast, small scale entrants may find themselves handicapped by a high cost due to lack of scale economies, and a lack of market presence limits the entrant's ability to build brand loyalty and gain access to distribution channels. These scale effects are particularly significant when a company is entering an established industry in which incumbent companies possess scale economies, brand loyalty, and access to distribution channel. Normally, successful small-scale entry is associated with lower initial losses But in the long run, large scale entry generates greater returns. However, because of the high cost and risk associated with large scale entry, many companies make the mistake of choosing a small scale entry strategy, which often means they fail to build the market share necessary for long-term success. So two things to remember. One is, like, when we really start or really want to enter a new industry, we must be very careful about assessing how able we are to do it, and whether there is a market demand for that. Otherwise, and that is one thing. And the second one is, if you decide to go, then go with a large capital investment, because at the end of the day, a large entry or scale, where you can achieve economies of scale, where you can achieve where you can build brand loyalty in the long run, we companies can achieve those. uh, Second is commercialization. Many internal new ventures are driven by the opportunity to use a new or advanced technology to make better products for customers and outperform competitors. But to be commercially successful, the products under development must be tailored to meet the needs of the customers. Many internal new ventures fail when a company ignores the needs of the customers in the market. The company can be so obsessed about the technological side, but they can ignore what the customers actually want. Thus, a new venture may fail because it is marketing a product based on technology for which there is no demand, or the company fails to correctly position or differentiate product in the market that can attract customers. Number 3, poor commercialization. Managing the new venture process and controlling the new venture division creates many difficult management and organization problems. For example, one common mistake some companies make is to try to increase their chances of introducing successful product is to establish too many different internal new venture divisions at the same time. So they probably try to launch or develop maybe more than manageable number of products at the same time. Another common mistake is when corporate managers fail to do the extensive advanced planning necessary to ensure that the new venture business model is sound and it contains all the elements that will be needed later if it is to succeed. But the failure to anticipate the time and cost involved in new venture process constitutes a further mistake. So how do we make sure that this initial new venturing will have more likelihood to be successful? Now, in order to avoid the pitfalls that we just discussed, a company should adopt a well thought out structured approach to manage internal new venturing. New venturing is based on research and development. So it begins with exploratory research necessary to advance basic science and technology, and development research to identify, develop and perfect the commercial application of a new technology. So we need good R&D as well as marketing in here, and that should be well structured, well planned. Companies can take a number of steps to ensure that good science ends up with a good commercially viable products. Number one, many companies must place the funding for research into the hands of business unit managers who have the skills or know-how to narrow down and then select the best research projects. Instead of starting 10 new product development projects, they should be actually narrowing down based on a good assessment and select few from there. Number two, a company's top managers must work with R&D, research and development scientists, to continually develop and improve the business model and strategies that guide their efforts to make sure that all scientists and engineers understand what they have to do to make it succeed. Third, a company must also foster close links between research and development and marketing to increase the probability that a new product will be a commercial success in the failure. Otherwise, you have developed a good scientific kind of a product, but it has no commercial value. So marketing and research and development department should work collaboratively. Next, a company should foster close links between R&D and manufacturing too, because they are the people, the production and manufacturing, the people who will be actually producing this product. They have to have the competencies and capabilities. If they don't have, they should work collaboratively with research and development to see what capabilities they need to actually build, or how the product should be redesigned by research and development so they can make it in a cost effective way. And finally, the company should construct efficient scale manufacturing facilities and give marketing a large budget to develop a future product campaign. Promotion is important, and this campaign should build market presence and brand loyalty quickly and well in advance of that product's introduction. The next method of entering new industry that we are going to discuss is acquisition. Acquisitions are the main vehicle that companies use to implement a horizontal integration strategy. They are also a principal way companies enter new industries to pursue vertical integration and diversification. So it is necessary to understand both the benefits and risks associated with using acquisition to implement a corporate level strategy. Why companies use acquisition? In general, acquisitions are used to pursue vertical integration or diversification when a company lacks the distinctive competencies necessary to compete in a new industry, so it uses its financial resources to purchase and establish a company that has those competencies. Entering a new industry through internal new venturing is a relatively slow process. Therefore, acquisition is a much quicker way for a company to establish a significant market presence. Acquisitions are often perceived as being less risky than internal new ventures because they involve less commercial uncertainty because it is an established company where company is buying. And because of the risks of failure associated with internal new venturing, it is difficult to predict its future success and profitability. Acquisitions are an attractive way to enter an industry that is protected by high barriers to entry. When the entry barriers are high, it may be very difficult for a company to enter an industry through internal new venturing because it will have to construct large-scale manufacturing difficulties and invest in a massive advertising campaign to establish brand loyalty, which are difficult goals that require huge capital expenditures. Acquisitions have long been the most common method that companies use to pursue diversification. However, acquisitions may fail to raise the performance of the acquiring companies for the following reasons. Number one, companies frequently experience management problems when they attempt to integrate a different company's organizational structure and culture into their own. After an acquisition, many acquired companies experience high management turnover because their employees do not like the acquiring company's way of operating and its structure and culture. Research suggests that the loss of management talent and expertise and the damage from constant tension between the businesses can materially harm the performance of the acquired unit. Second, companies often overestimate the potential economic benefits from an acquisition, and so they pay more for the acquired company than it is actually worth. One reason is that top managers typically overestimate their own personal general competencies to create valuable new products from an acquisition. Usually, when managers reach to the top of a company, they develop an exaggerated sense of their own capabilities and self-importance that distorts their strategic decision making. This is due to their overconfidence as a general manager. And third, and perhaps the most important reason for the failure of acquisition is that acquiring a company with stock that is publicly traded tends to be very expensive, and the expense of the acquisition can more than wipe out the value of the stream of future profits that are expected from the acquisition. One reason is that top managers of the company that is targeted for acquisition are likely to resist any takeover attempt unless the acquiring company agrees to pay a substantial premium above its current market value. These premiums are often 30 to 50% above the usual value for value of a company's stock. The reason why the acquiring company must pay such a premium is that the stock price of the acquisition target increases enormously during the acquisition process as investors speculate on the final price of the acquiring company will pay to capture it. You have probably seen, like, when one company acquires another company, the day when the announcement comes to the stock market, the price of the acquired companies start rising from that moment heavily, whereas the stock price of the acquiring company actually goes down from that day. Generally, in the case of contested bidding contest, in the case of a bidding contest where two or more companies simultaneously bid to acquire the target company, its stock price may surge. And finally, companies are often negligent in screening their acquisition targets and fail to recognize important problems with their business models. Researchers have discovered that one important reason for the failure of an acquisition is that managers make the decision to acquire other companies without thoroughly analyzing potential benefits and cost. In many cases, after an acquisition has been completed, many acquiring companies discover that instead of buying a well-managed business with a strong business model, they have just purchased a troubled organization. And the last one is that managers may have incentives to make acquisition even when they do not increase shareholder value. That is called normally agency problems. Managers may make acquisition for reasons that have nothing to do with the shareholders value, which is for example, managers often have a large portion of their personal wealth tied to the firms they manage, making them under-diversified. A move to diversify the firm may not be the interest of other shareholders. In order to avoid pitfalls and make successful acquisition, companies need to follow an approach to targeting and evaluating potential acquisition that is based on four main steps. So let's discuss those steps. Number one, target identification and pre-acquisition screening. Thorough pre-acquisition screening increases a company's knowledge about a potential takeover target, and it lessens the risk of purchasing a problem company, the one with a weak business model. An acquiring company should select a set of top potential acquisition targets and evaluate each company using a set of criteria that focus on revealing the company's financial position, its distinctive competencies and competitive advantage, its changing industry boundaries, its management capabilities, and its corporate culture. Once a company has reduced the list of potential acquisition candidates to the most favored one or two, it needs to contact expert third parties such as investment bankers. These companies' business model are based on providing valuable insights about the attractiveness of the potential acquisition, assessing current industry competitiveness, and handling many other issues surrounding an acquisition, such as how to select the optimal bidding strategy for acquiring the target company's stock and keep the purchase price as low as possible. Second is bidding strategy. The objective of the bidding strategy is to reduce the price that a company must pay for the target company. The most effective way a company can acquire another is to make a friendly takeover bid, which means the two companies decide upon an amicable way to merge the two companies, satisfying the needs of each company's stakeholders and top managers. A friendly takeover prevents speculators from bidding up stock prices. By contrast, in a hostile bidding environment, the price of the target company often gets bid up by speculators who expect that the offer price will be raised by the acquirer or by another company that might have higher counteroffer. Another essential element of a good bidding strategy is timing. With good timing, a company can make a bargain purchase. Third is integration. Despite good screening and bidding, an acquisition will fail unless the acquiring company possesses the essential organizational design skills needed to integrate the acquired company into its operation and quickly develop a viable multi-business model. Integration should center upon the source of potential strategic advantage of the acquisition. Integration should also involve steps to eliminate any duplication of facilities or functions. In addition, any unwanted business units of the acquired company should be divested. And finally, learning from experience. Research suggests that companies which acquire many companies over time become an expert in this process and can generate significant value from their experience of the acquisition process. Their experiences enable them to develop a playbook that they can follow to execute an acquisition most efficiently and effectively. So the last method of entering a new industry is joint venture. In joint venture, two or more companies agree to pool their resources to create new business, and they are most commonly used to enter an embryonic or growth industry. Suppose a company is contemplating creating a new venture division in an embryonic industry. Such a move involves substantial risks and cost. The company must make the huge investment necessary to develop the set of value chain activities required to make and sell products in the new industry. In this situation, a joint venture frequently becomes the most appropriate method to enter the new industry because it allows a company to share the risks and costs associated with establishing a business unit in the new industry with another company. This is especially true when the companies share complementary skills or distinctive competencies because this increases the probability of a joint venture success. While joint venture benefits both partner companies, it may result in some problems in certain conditions. First, although a joint venture allows a company to share the risk and cost of developing a new business, it also requires that they share the profits if it succeeds. Second, the joint venture partners may have different business models, strategies, or priorities, or time horizons, and problems can arise if they start to come into conflict about how to run the joint venture. These types of problems can disintegrate a business and result in failure. And finally, a company that enters into a joint venture runs the risk of giving away important company specific knowledge to its partner, which might then use this knowledge to compete with its other partner in the future. What we have seen that through related and unrelated diversification strategies, companies can increase their value and growth and profitability, but sometimes companies need to exit industries to increase their profitability and split their existing business into separate independent companies. And restructuring is the process of reorganizing and divesting business units and exiting industries to refocus upon a company's core business and rebuild its distinctive competencies. Commonly, firms firms focus on fewer products and markets following restructuring. So why do companies restructure? Once they diversify, then why do they restructure? Generally, restructuring is used to deal with acquisitions that are not reaching expectations. That means the companies have failed to create any value through acquisition. One main reason that diversified companies have restructured in recent years is that the stock market has valued their stock at a diversification discount, which means the stock of a highly diversified company is valued lower relative to their earnings than the stock of less diversified companies. Investors consider highly diversified companies as less attractive investment for four important reasons. Number one, investors often feel these companies no longer have multi-business models that justifies their participation in many different industries. Number two, the complexity of the financial statements of highly diversified enterprise disguises the performance of its individual business units. So investors, they really cannot figure out which companies has contributed what percentage of profit of the whole corporation or conglomerate. So it is a little bit difficult for the investors. And many investors have learned from experience that managers often have a tendency to pursue too much diversification, maybe for wrong reason. Their attempts to diversify actually reduces profitability. And finally, innovations in strategic management have diminished the advantage of vertical integration or diversification. We have now seen that there are many other alternatives instead of diversification and vertical integration. We can go for strategic alliance, short-term and long-term contract, although long-term contract would be more beneficial for both parties. Companies may use three types of restructuring strategies. First one is downsizing, then downscoping, and leverage buyouts. Downsizing is a reduction in the number of a firm's employees and in the number of its operating units, but it doesn't change the essence of the business. Downscoping refers to divestiture, spin-off, or some other means of eliminating business that are unrelated to a firm's core business. And leverage buyout happens when a party buys all the assets of a business and then finances largely with debt and takes the firms private That means they no longer trade the firm's shares publicly. Now, downsizing is normally tactical. It is short-term oriented. It just cuts the labor cost, and if acquisition fails to create any anticipated value, then we go for downsizing, and it pays too much. And we do downsizing when the company paid too much for the target company. While downscoping is more strategic and long-term oriented, is focused on a core business, and it is more positive. It has got more positive effect on firm's performance than downsizing. Now, in leverage buyout, we can see that private equity firms facilitate or engage in taking a firm public from private. A significant amount of debt may be incurred to finance this buyout, because when some other company or the management or the employees are buying out the company, they may not have enough capital, so they have to go for debt capital, and which can be very expensive. And the third one, a firm may immediately sell of non-core asset to pay down debt. Leverage buyouts can be of three types: management buyouts, employee buyouts, and whole firm buyouts. In the first case is the company's management who buys the company. The second case, employees of the company, they buy the company. The third is another third party companies can buy the whole company. Now, management buyouts, more so than employee buyout and whole firm buyouts, lead to downscoping, increased strategic focus, and improved performance. And research shows that management buyout can also lead to greater entrepreneurial activity and growth. So out of these three, management buyout probably is a better buyout strategy. And finally, we talk about the restructuring strategies. What are the three different alternatives that we have just seen: downsizing, downscoping, and leverage buyout? But what are the outcomes in terms of the short term as well as the long term? In the short term, downsizing, it actually reduces labor cost, and in the long term, loss of human capital and lower performance. So we are actually losing because we are getting rid of some of the critical employees or good employees or skilled employees. And downscoping, you see, it reduces debt cost because we are getting rid of all those business units that are not related to our core business, and that emphasis on strategic control. So that one is that one actually leads to better or higher performance. And the third one is leverage buyout. Leverage buyout also, it emphasizes on strategic controls, get rid of all those assets that are not needed, focus on the current core or our core competencies and core business, and but it has got high debt cost because these managers and employees may not have the required amount of investment that required to buy the company. So you have to go for the companies need to go for the debt capital, and if the company's performance has not been very good in the last few years, then this debt capital cost could be very high. So it is actually it is, there is higher risk, but it can also improve companies performance. Okay, so with that we finish in here. Thank you very much.